Hello everybody, welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, today's video, why interest rates don't really matter that much and why interest rates are not having this big effect on housing.
Okay.
We're going to discuss this in detail. We have a lot of data that proves historically that the interest rates have almost no effect on home prices, despite what people would naturally think, right?
Okay.
Okay, so we're going to start with the chart. First chart, this is a Fred chart. Household debt service payments is a percentage of disposable personal income, okay? If you go back to the very highest part, you can see there that was right for the great financial crisis, housing crash, 2006, 7, 8, was a little over 13%. So 13% of all disposable income that came in went to make mortgage payments, right? As you can see now, it's basically the lowest it's ever been. Matter of fact, even today, it's less than it was every year between 2020 and as far back as this chart goes, which looks like 1980.
Right. So there are a lot of reasons for this. So we start out with the fact that 42% of homes are free and clear, so there is no portion of their income that is being allocated to mortgage payments.
Let me preference this really quick, Wanda. The idea is that the 7% rates, we had 7% rates back in 2005 and 6.
Right.
Okay, so the rates are the same as they were back then.
Right.
But you can see that the amount of actual percentage of payments is less. Okay, Wanda, so that was your first point.
Right.
Was it 42% of all homes are free and clear?
Right. The second portion.
Do we know what it was back then? It was a lot less. It was under 30, right?
It was, it was more like, it was in the 20s.
20s.
I think it was in the low 20s.
Okay.
Yes. Okay. The second caveat to the whole thing is that most people have sub 4% mortgages. Remember, what mortgages there are out there, most of them are sub 4%. So again, the fact that we have 7% mortgages, that's I understand, but
that's just for people right now.
Right.
Okay.
So that means that those people with those sub 4% mortgages, they have lower payments for a number of reasons. First of all, it's a lower interest rate, easy, right? Second of all, they've put money down, so their principal balance is lower to begin with. So again, they have lower payments. Those that refinance, they refinanced off of, again, a lower balance than the original purchase price. So again, that payment is lower. And then the third reason that shows up in the way it does is because even with those people that have the 7% mortgages, they make up such a small portion of the people with mortgages out there that it's not enough to move that needle from, historical lows.
Yeah, so even if somebody's getting 100%, or, like FHA financing, they're putting 3.5% down, they're getting 7%, it's, 30% of their income. It's such a small percentage of the population. And remember, we know that on average, people that are getting loans, on average, put 18% down.
Right.
So half the people are putting more, half the people are putting less. We know that over a third of all homes right now are being purchased cash. Mm-hmm. And all the people who own their home free and clear or have substantial equity are not just going to cave on their price because somebody else needs their house. See, that's the big argument that I think people are making. But Todd, it's like a teeter-totter. They can afford less house. Oh, that's your problem. That's the buyer's problem. That's not the seller's problem. The seller's problem is not that interest rates are high for you and that you want to live in their house. They have to take the price so you can have it. I mean, why not just go say, look, I want to live in a $5 million house in La Jolla overlooking the Pacific Ocean, but I make $20,000 a year, so I need you to drop the price so I can afford it. That's a ridiculous argument.
Correct.
Okay, second chart. Okay, 30-year fixed mortgage average in the U.S. This is it historically, okay? You can see all the way to the right, there we are at our 7% interest rates. Mm-hmm. Yes, recent history, last 15 years, interest rates were lower. Mm-hmm. But if you go from 2000 all the way back to 1970, interest rates were 7 or higher. Go look at the chart. It's pretty straightforward. From before 2000 all the way to 1970, interest rates were much higher. In some cases, they were up to 18%. Okay, so if 7% interest rates are so bad that nobody could afford and that home prices should fall. Like there's some number where home prices stay the same, and then if they get below that, they go up, and if they get to 7, they go down, right? So remember this chart. Look at how high interest rates were from 1970 to 2000. Okay, you got that memorized?
You got it memorized.
Here's the next chart. This is what home prices did in the U.S. from 1970 to 2000. Juana, what are home prices doing in this chart?
They are consistently going up.
Okay, but wait. How is this possible? How is this possible home prices went up with all these crazy interest rates are all over the place?
People didn't get the memo?
People didn't get the memo.
No, seriously. In all seriousness, home prices go up because of supply and demand. Home prices go up because of inflation. Home prices go up because of a number of reasons. And affordability, while it impacts some people, it certainly does not impact everyone. And as we look at this chart, the thing to keep in mind is that back in the 70s and 80s, very few people, if any, purchased homes cash. But as we keep kind of plugging along, more and more people purchase homes cash. So even certainly when we got the Great Recession, there were lots of homes being purchased cash. Here in Las Vegas, half the homes or more were being purchased cash every month. So you've got all this equity being built all along the way. So equity is being built in a number of ways. It's being built through people purchasing homes cash. It's being built through people making mortgage payments. And it's being built through appreciation. So all of these are working to build equity. And as the equity grows, so does this really nice little chart that shows you the home appreciation. Homes are appreciating over time, and they're appreciating pretty steadily. I think you'd be hard pressed to say that homes have not appreciated historically, right?
No, they have. Like literally, if you pick any 10-year period, from starting at 1900 and just pick 10 years, and I spun a wheel, it was going to land on a year, 1937. Home prices be more 10 years later. And I made you make a 50-50 bet on each one of those. Would any of you even bet once that home prices would be less? Probably no, because there's probably only 2 or 3 years in there where if you looked out 10 years, home prices were actually less. There may not be any over 10 years. We saw a thing, we did a video a bunch of years ago where they analyzed 15-year period. It was either 14 or 15 years over the since they've been measuring home prices since like 1900. And not once did home prices go down over, there's no 14-year period where home prices went down. They've always gone up over and yes, there were some times when, home prices went down. But if you're fighting against home prices, it's just like the king who, remember he passed the law to stop the tides from going, right?
Right.
It didn't work very well.
No.
The tides did not listen to the king.
No, this is kind of what you're seeing is you're seeing, population growth. You're seeing economic growth. You're seeing the advent of innovation and all these things. And all of these things are working toward toward prices going up. And the idea that interest rates alone are responsible for home prices going up or down is naive. The home prices are much more complex than that, and over time, home prices do tend to go up. As the chart shows, it's not our chart; it comes from Fred, and you can go online and find it yourself. They have lots of cool charts. So it's just kind of an interesting thing to keep in mind. And then the other thing that we want to talk about was how different the borrowers are today than they were they were prior to the Great Recession, particularly immediately prior to the Great Recession. Buyers today are well qualified. Their scores are well into the 700s. They're putting 20% down. So that
they actually are going through underwriting that, like, they have to have a job. They have to have pay, 2 years of right. pay stubs and W-2s.
They have to have documentation. When you're looking at what precipitated the Great Recession, you're looking at the borrowers had, like, the average credit score was like 640. They didn't have to provide any documentation. They just simply were not well qualified buyers. So it's a whole different situation today. People getting loans, they are much less likely to get in trouble than people getting loans back then. That's not to say that people won't, but very few will, because it's a whole different lending practice than it was back then. And then when you couple that with the amount of equity in homes, with the amount of people who own homes free and clear, now you've got so much support for the market that even the people that may be in distress will not be enough to negatively impact the market. And they won't be enough for you to get a deal, is what I'm getting at. This is what I really want to drive home. There will be so few that it would be very difficult to get a deal. Look, there are lots of investors out there. I get calls and text messages and emails every day, investors saying, hey, do you have anything off market? Do you have anything I can buy without competing with anyone else? What does that tell you? That tells you that the open market is very competitive, that these guys are trying to get a deal, and that they're pretty desperate when I'm getting so many phone calls, text messages, and emails every day. And I'm not the only one. Anybody with a real estate license is getting these. So it just kind of gives you perspective on how the market is different today, and how interest rates are not having the negative impact that some people expected them to have.
Interest rates 2 years ago were 3%, 2021. Okay? They're more than double now. Home prices today, way higher than they were 2 years ago.
Right.
Way higher. Home prices today in the U.S. indexed are higher than they were a year ago. Like, home prices are up. So if what you're saying is true, why haven't we seen it in the price of homes that have sold? Like, homes should be selling for half as much. If it's like a bond, where if the interest rate goes up, the value of the bond goes down, and if the interest rate goes down, the value of the bond goes up, because they do have that inversely proportional relationship. Why don't we see it with home prices? Why are home prices higher today than when they were? Why did home prices from 1970 to 2000 just keep kind of going up at a steady pace, even though interest rates went from 7 to 18 and then down to 7?
Right.
Why didn't we see any change? I'm going to put the chart back up. Okay, here's the chart. This is the chart of interest rates in the U.S. Look at how crazy that is from 1970 to 2000. Okay? Why don't we see it why don't we see that represent this chart if it's interest rate driven? The logic that, oh no, it only today is, like, you'll see next year when rates go to 8. That's when you'll see it. Well, I mean, I've been looking at 50 years of history here and I'm not seeing it. That the point we're trying to make is, yes, it affects affordability. Does affordability affect demand? It does, but it's a minor point. It's a minor part.
Right, because for the people for whom affordability is an issue are a small portion of the market. This is kind of what we're trying to say. Now, part of the reason why that is because we have so little inventory. Okay, so look, if you have 10 houses to sell and you have 30 buyers and 2 of them can't afford it, don't worry about it. You got 28 others that are going to buy those 10 houses, right? Which you don't have 28 houses to sell, you only have 10. So the 2 who can't afford it, don't worry about it. But, you know, if our inventory was reversed, if we had an abundance of inventory, then affordability would play a much higher role in all of this. But affordability isn't really playing a big role right now because we have low inventory levels. So that's kind of the story.
If interest rates were 3% and we had 20,000 homes on the market in Las Vegas, we would sit right here in front of you and say home prices are going to fall, just like we did back in 2006 on the radio show, where we said this is 26,000 homes is too many. Something's got to give.
Right.
This is bad. This is setting up for something bad. So,
right.
Yeah.
So the inventory just isn't there, and that's really what would move the needle. I know we've said this and we're kind of beating it to death, but it is a really important point to always look at. So what do you think is going on in the market? Tell us where you're watching from and what's happening in your market. Please remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.